Michael buys a rental property. Lisa puts the same money into REITs. They both think they made the smarter choice. They are both about to find out they were wrong about something. And the number that separates them after 20 years is not what either of them expected. Let's run the real math. Let's make this completely fair. Michael and Lisa are the same age, same city, same financial starting point. They both have $50,000 saved. They both earn $70,000 a year. The only difference is what they do with that $50,000. Michael uses his $50,000 as a down payment on a $250,000 rental property, a modest 3-bedroom house in a decent neighborhood. He takes out a 30-year mortgage at 7% interest. His monthly mortgage payment is about $1,330. He finds a tenant willing to pay $1,800 a month. On paper, that is $470 a month in profit before he spends a single dollar on anything else. Michael feels like a genius. Lisa takes the same $50,000 and puts it into a diversified REIT portfolio. REITs are real estate investment trusts. They own and operate income-producing real estate apartment complexes, office buildings, shopping centers, warehouses, hospitals. When you invest in REITs, you own a slice of all of it. No mortgage, no tenants, no keys to hand over. Lisa sets up an automatic contribution of $400 a month and doesn't think about it again. Her coworkers ask her what she's investing in. She says REITs. They nod politely and change the subject. Nobody is impressed. On day one, Michael has a house, a tenant, and a story to tell at dinner parties. Lisa has a brokerage account and a confirmation email. It is not even close in terms of how it feels, but feelings and math have never agreed on much. Here is what most people do not understand about REITs before we run a single number. REITs are legally required to distribute at least 90% of their taxable income to shareholders as dividends. That means REITs pay you cash every quarter without you doing anything. The average REIT dividend yield historically sits between 4% and 5% annually. On a $50,000 investment, that is $2,000 to $2,500 per year in dividends alone, before any price appreciation, before any compounding. Just cash showing up in your account. Michael's $470 a month cash flow sounds better, but let's look at what actually hits his bank account after everything else comes out. Property taxes run about $3,000 a year. Insurance adds another $1,500. Maintenance and repairs budget. At 1 to 2% of property value annually, that is $2,500 to $5,000 per year. Vacancy runs about 1 month per year on average. That is $1,800 in lost rent, plus cleaning and relisting costs. Capital expenditures roof, HVAC, water heater need to be budgeted at roughly $1,500 to $2,000 per year as a reserve. Michael manages the property himself to save money. That means phone calls at 10 p.m., weekend showings, and coordinating repairs on his lunch break. After all real costs, Michael's actual net cash flow in year one is somewhere between $0 and $1,500. Not the $5,640 that the $470 monthly number promised him. Lisa's first year looks quieter. Her $50,000 plus $400 monthly contributions generates roughly $4,800 in dividends. Her total portfolio with average REIT returns historically around 11 to 12% annually, including dividends, is sitting at about $61,000 to $63,000 by end of year one. She spent 0 hours managing anything, 0 phone calls, 0 emergencies. By year 3, Michael is deep in the reality of being a landlord. He has replaced a water heater for $1,200. Dealt with 1 month of vacancy that cost him $1,800 in lost rent. Fixed a plumbing issue for $800. His actual net cash flow over 3 years after all real costs is somewhere between $3,000 and $6,000. His property is appreciated roughly 3 to 4% per year and is now worth around $270,000 to $280,000. His equity, what the house is worth minus what he owes, has grown to about $55,000 to $65,000. That equity is real. That is the power of leverage working for him. Lisa's portfolio at year 3 with consistent $400 monthly contributions and 11% average annual returns is sitting at approximately $85,000 to $90,000. She has put in $50,000 plus $14,400 in contributions. The rest is dividends reinvested and price appreciation. She has received roughly $7,000 to $9,000 in cumulative dividend payments. She spent 0 weekends fixing anything. Here is the number that surprises most people at this stage. Lisa's liquid portfolio of $85,000 to $90,000 is already ahead of Michael's equity of $55,000 to $65,000. And Michael still has $190,000 in debt attached to his asset. Lisa has no debt attached to hers. Now here is where Michael's leverage argument gets powerful. Michael did not use $250,000 to control $250,000 in assets. He used $50,000 to control $250,000 in assets. That is 5-to-1 leverage. And when that property appreciates, the gains are calculated on the full $250,000, not just his $50,000. A 4% appreciation on $250,000 is $10,000. A 4% appreciation on $50,000 is only $2,000. That leverage multiplier is real, and it is the single most powerful argument for rental property over REITs. But leverage is a weapon that cuts both ways. If property values drop 10%, Michael loses $25,000 in equity on paper. Lisa's REIT portfolio might drop too in a bad market, but she carries no debt obligation. Michael still owes $1,330 every month whether his tenant is paying or not. By year 5, the story is developing in ways neither of them fully predicted. Michael has raised rent to $1,950. His property is worth roughly $295,000 to $310,000. His equity has grown to approximately $80,000 to $95,000. But his actual cumulative net cash flow after 5 years of real expenses is somewhere between $5,000 and $12,000. He has spent somewhere between 300 and 500 hours managing the property. If you valued that time at even $25 an hour, that is $7,500 to $12,500 of unpaid labor factored into the return. Lisa's portfolio at year 5 with reinvested dividends and price appreciation is sitting at approximately $130,000 to $145,000. Her cumulative dividend income over 5 years is roughly $15,000 to $20,000. All of it has been automatically reinvested. She has not thought about this investment in 5 years. At year 5, Lisa is clearly ahead in liquid net worth. Michael is behind in liquid net worth but has a leveraged asset that is building equity faster than the numbers suggest. Here is the year 10 comparison that changes the conversation. Michael's property is worth approximately $335,000 to $360,000. His remaining mortgage balance is about $166,000. His equity is approximately $170,000 to $194,000. His cumulative net cash flow over 10 years after all real expenses, repairs, vacancy, taxes, and insurance is somewhere between $10,000 and $25,000. He has put in roughly 600 to 1,000 hours of management time over a decade. Lisa's portfolio at year 10, with $400 monthly contributions and 11% average annual returns, including dividends, is sitting at approximately $230,000 to $260,000. Her total contributions were $50,000 plus $48,000. The remaining $130,000 to $160,000 is pure compounding and reinvested dividends. She has attended 0 landlord emergencies. At year 10, Michael's total wealth position, including equity, is roughly $170,000 to $194,000. Lisa's total wealth position is roughly $230,000 to $260,000. Lisa is ahead. On a completely passive, zero leverage portfolio, here is where the story fully separates. At year 15, Michael's property has continued appreciating. It is now worth approximately $420,000 to $460,000. His mortgage balance is down to roughly $120,000. His equity is approximately $300,000 to $340,000. Leverage has been compounding for 15 years, and the equity growth is accelerating. His cumulative net cash flow over 15 years is somewhere between $20,000 and $45,000. Lisa's portfolio at year 15 is sitting at approximately $430,000 to $490,000. The compounding curve has bent sharply upward. Her monthly dividends alone are now generating roughly $1,800 to $2,200 per month, automatically, without a single tenant interaction. At year 15, they are surprisingly close in total wealth. Michael's equity of $300,000 to $340,000 versus Lisa's portfolio of $430,000 to $490,000. Lisa is still ahead, but Michael's leverage is doing serious work. By year 20, the final numbers are in. Michael's property is worth approximately $490,000 to $540,000. His mortgage is nearly paid off, with a remaining balance of around $60,000 to $70,000. His equity is approximately $420,000 to $480,000. And now, for the first time, his cash flow dramatically improves. With rent at roughly $2,400 and almost no mortgage to service, his monthly net income from the property is somewhere between $800 and $1,200 after expenses. 20 years of leverage has built him something real. Lisa's portfolio at year 20 with consistent contributions and reinvested dividends is sitting at approximately $580,000 to $660,000. Her monthly dividend income is roughly $2,400 to $3,000. Automatically deposited, no property to manage, no debt to service, no tenants to deal with. Here is the final side-by-side. Michael, $420,000 to $480,000 in equity, $800 to $1,200 monthly cash flow, roughly 800 to 1,200 hours of management time invested over 20 years, significant debt carried for most of that period. Lisa, $580,000 to $660,000 in portfolio value, $2,400 to $3,000 monthly, passive income, 0 hours of management, 0 debt. Lisa wins on total wealth. Lisa wins on passive income. Lisa wins on time invested. But Michael's result is not bad. $420,000 to $480,000 in equity, built with $50,000 down, is a powerful outcome. And if Michael had bought a second property in year 7 when his equity allowed it, this story ends very differently. Here is what REITs cannot do that rental property can. You cannot leverage REITs the way you leverage real estate. A bank will not lend you $200,000 to buy REITs. That leverage multiplier is unique to physical real estate, and it is the reason real estate creates more millionaires than almost any other asset class. REITs also cannot be house hacked. You cannot live in a REIT and eliminate your own housing costs while building equity. And REITs do not offer depreciation tax deductions the way direct real estate ownership does. Here is what rental property cannot do that REITs can. REITs are liquid. If Lisa needs $30,000 tomorrow, she can sell a portion of her portfolio in minutes. If Michael needs $30,000 tomorrow, he either takes out a loan against his property or sells the whole thing. REITs are diversified across hundreds of properties in dozens of markets. Michael's entire real estate wealth is concentrated in one house, on one street, in one city. If that neighborhood declines, his entire position declines with it. And REITs require 0 management, 0 phone calls, 0 emergencies, 0 weekends lost. The honest answer is that neither investment is universally better. REITs win on liquidity, diversification, passivity, and total return in this comparison. Rental property wins on leverage, tax advantages, and the ability to scale aggressively with borrowed money. The investor who wins is not the one who picked the right asset. The investor who wins is the one who understood what they were actually buying, the returns, the risks, the time cost, and the leverage implications before they signed anything. Michael and Lisa both made reasonable decisions, but only one of them knew exactly what they were getting into on day one. And if you are sitting there trying to decide between these two right now, there is one question that cuts through everything else. Do you want to build wealth actively or passively? Because the answer to that question determines which one is actually right for you, and the math will follow from there.